Welcome to Unlocking the Upside, where we turn Wall Street's complexity into crystal clear investment wisdom. I'm Jeff Robinson, and after spending 25 years in the trenches, from leading a number one ranked research team on Wall Street to building and selling companies, I'm here to share the insights that can only come from being in the room where it happens. I founded theinvestmentanalyst.com to bring institutional level analysis to everyday investors, and now I'm taking it one step further with this podcast. And I'm not alone on this journey. Meet my co-host, Hope Stott.
Thanks, Jeff. And yes, I'll be the one making sure we break down these Wall Street concepts into real-world applications that our listeners can actually use. Someone's got to keep this Wall Street veteran grounded. We're here to challenge what you think you know about investing and show you angles that most people never consider. Each week, we'll peel back the layers of the market, revealing opportunities hiding in plain sight. We're not just giving you fish, we're teaching you how to spot the best fishing spots that others walk right past.
Whether you're managing a multi-million-dollar portfolio or just dipping your toes into the market, we're committed to expanding your investment toolkit with practical strategies and real-world examples. No jargon, no gatekeeping, just straight talk about what works and what doesn't. Get ready to see the market through a new lens. This is Unlocking the Upside. Let's dive in. Imagine a world where Wall Street traders take cues from flocks of birds. Well, that's exactly what we're diving into today as we explore how the mesmerizing aerial ballet of Starlings is revolutionizing our understanding of financial markets.
Hold on, are we really talking about birds and stocks in the same breath? This sounds like a stretch.
I know it sounds wild, but bear with me. We're about to unpack some groundbreaking research that's challenging everything we thought we knew about market behavior. It all starts with the work of Giorgio Parisi and his fascination with starling murmurations.
Murmurations? You've lost me already. What exactly are those?
Sorry, let me back up. Murmurations are those incredible aerial displays where thousands of starlings move in perfect synchronization. You've probably seen videos of them online. What's fascinating is that these complex patterns emerge from just 3 simple rules each bird follows.
Okay, I think I've seen those. But I'm still not seeing the connection to finance.
Well, that's where it gets interesting. Paris realized that financial markets behave in surprisingly similar ways to these bird flocks. Both are examples of complex systems where simple individual behaviors lead to unpredictable group outcomes.
I can see how markets might be complex, but are you saying they're as unpredictable as a flock of birds?
In many ways, yes, and that's why traditional financial models often fall short. They assume markets behave rationally and predictably, but reality is much messier. And Paris identified 5 key principles that connect starling flocks to market behavior.
5 principles? That sounds like a lot to unpack. Can we take them one by one?
Absolutely. Let's start with the first principle: local information and global patterns. In starling flocks, each bird only pays attention to its 7 nearest neighbors. They don't need to know what the entire flock is doing to create those amazing patterns we see.
And how does this apply to financial markets?
Think about how information flows in the financial world. Analysts follow their sector peers, traders watch their regular counterparties, and investors track similar strategies. Just like starlings, market participants primarily respond to their immediate information environment.
So you're saying we don't need to understand everything happening in the market to make good decisions?
Exactly. Parisi uses the 2008 financial crisis as an example. The crisis started with specific mortgage-backed securities and then cascaded through the system, much like how a predator's appearance causes a wave of movement through a starling flock.
That's a powerful analogy. What's the second principle?
The second principle is phase transitions and critical points. This is about how systems can suddenly change behavior when certain conditions are met. In physics, it's like water turning to ice. In starling flocks, it's when they suddenly change direction or density.
And in markets? I'm guessing this relates to crashes and bubbles?
You've got it. Think about the dot-com bubble's collapse. For months, valuations kept stretching higher without triggering a systemic response. Then, seemingly overnight, the entire market psychology shifted. The system had reached a critical point where local interactions suddenly produced dramatically different global behavior.
That's a really interesting way to think about market crashes. What's the third principle?
The third principle is scale, free behavior, and power laws. This one's a bit more technical, but bear with me. Essentially, it means that the patterns you see in a small group repeat themselves in larger groups, just at different scales.
Okay, I'm following. But how does this apply to markets?
Well, it challenges the idea of normal distributions that we often assume in financial models. Instead, market movements follow power law distributions. The same patterns repeat at different scales, from minute-by-minute movements to decade-long trends. And
that sounds like it could have huge implications for how we model risk in the financial world.
Absolutely. It means that those black swan events, extreme market movements, happen far more frequently than traditional models predict. This has enormous implications for risk management strategies.
I can see why this would be crucial for investors to understand. What's the fourth principle?
The fourth principle is feedback loops and adaptation. In starling flocks, each bird's movement affects its neighbors, creating ripples of influence throughout the flock. This allows the flock to adapt to changing conditions in real time.
And how does this play out in financial markets?
A great example is the rise of passive investing. As more capital flows into index funds, the stocks in major indices experience increased buying pressure, improving their performance, which in turn attracts more passive investment. It's a feedback loop that has fundamentally altered market dynamics.
That makes a lot of sense. I've heard a lot about the growth of passive investing in recent years. And the final principle?
The fifth principle is emergence and unintended consequences. This is about how complex system-wide behaviors arise from simple individual rules. No single starling intends to create those beautiful patterns we see. They emerge from countless local interactions.
Let me guess, the same thing happens in markets?
You've got it. Market phenomena often emerge in ways no individual participant intends. Parisi uses the example of high-frequency trading. Each firm developed algorithms to execute trades more efficiently, but collectively they created an entirely new market microstructure with its own emergent properties.
This is all fascinating, but I'm wondering how investors can actually use these insights in their day-to-day decision-making.
That's a great question. Parisi offers several practical applications. For indicator development, he recommends tracking changes in correlation patterns across assets, monitoring the strength of feedback loops in your sector, and looking for signs of approaching phase transitions.
Those sound like they could be powerful tools. What about risk management?
For risk management, he suggests building portfolios that are robust to phase transitions, understanding that extreme events are more common than normal distributions suggest, and monitoring local information networks for early warning signs.
And how about strategy evolution? How can investors adapt their approaches based on these principles?
Parisi recommends adapting strategies to work with, not against, emergent properties, considering how your actions might contribute to system-wide feedback loops, and looking for opportunities created by others' misunderstanding of complex system dynamics.
This all sounds incredibly powerful. Can you give us an example of how these principles played out in a recent market event?
Absolutely. The March 2020 market crash and subsequent recovery is a perfect demonstration of complex system dynamics. Local interactions, individual COVID cases created global effects. The market hit a phase transition point when lockdowns began, and feedback loops like Fed intervention and retail trading drove the recovery.
It's amazing how well this framework seems to explain what happened. But what does this mean for the future of investing?
Well, Parisi believes that understanding markets as complex adaptive systems gives us a powerful framework for analysis that helps explain why traditional models often fail and suggests more effective approaches to investment strategy.
This has been absolutely fascinating. It's really changed how I think about markets. Any final thoughts on how investors can apply these insights?
Parisi leaves us with an interesting perspective. He says that just as no starling comprehends the entire murmuration, We don't need to understand every aspect of the market to navigate it successfully. We just need to understand the principles that govern its behavior as a complex system.
That's a powerful insight. It's humbling, but also liberating in a way.
Absolutely. And it opens up so many new avenues for research and strategy development. I think we'll be unpacking the implications of this for years to come. And
no doubt. Well, as we wrap up, what do you think are the key takeaways for our listeners?
I'd say the main takeaway is that markets are far more complex and interconnected than traditional models suggest. Investors need to be aware of feedback loops, emergent behaviors, and the potential for sudden phase transitions. It's about developing a more nuanced, adaptive approach to investing.
And I think it's also about recognizing the limits of our knowledge. We can't predict everything, but we can build strategies that are robust to uncertainty.
Exactly. Well, that's all the time we have for today. Remember, whether you're watching birds or watching stocks, it's all about understanding the bigger picture. Until next time, happy investing, and maybe take a moment to appreciate those starling murmurations. All the best from me, Jeff Robinson, and theinvestmentanalyst.com.
And me, Hope, always here to give Jeff a little bit of grief about what he says. Have a good rest of day.